At any given moment, a modern trauma center operates at maximum capacity, handling emergencies with relentless precision and speed. Scale that physical motion across 190 hospitals and 47 million annual patient encounters, and you have HCA Healthcare, America's largest for-profit hospital operator. The company's footprint concentrates in rapidly expanding Sunbelt markets like Texas and Florida, directly tethering revenue to the country's fastest-growing economic engines. This dual-axis chart compares HCA's operating results against its market valuation. Net income hits a record $6.8 billion after 19 consecutive quarters of growth, yet the stock price plunges 15%, dropping from $556 to $471 a share. We must determine if this 15% drop represents a permanent impairment to their business model or a temporary mispricing of a compounding cash machine. The market panic stems directly from Washington. In 2026, the Enhanced Affordable Care Act premium tax credits are set to expire. HCA estimates this regulatory shift creates a $600 to $900 million revenue drag. Add a projected $250 to $450 million decline in Medicaid supplemental payments from states like Tennessee, and the company faces a maximum $1.4 billion gross headwind. Management has already built a countermeasure. They are deploying a $400 million cost resiliency program, utilizing advanced AI and analytics. This optimizes both variable and fixed costs across their network. The board signaled their own read of the situation by authorizing a massive $10 billion share repurchase program, which is enough capital to retire roughly 4% of the total stock float. To find out who is right, the panicking market or the aggressive board, we must strip away the noise. We will run HCA through 5 distinct valuation frameworks to find its true floor. We begin with the Warren Buffett framework. He demands a toll bridge economic moat, competent management, and a consistent return on equity. HCA passes the moat test through its sheer geographic density. But as this formula visualization shows, calculating return on equity fails and returns a math error. Because HCA aggressively buys back stock, they have pushed their shareholder equity into negative territory. By swapping that metric for return on capital, the company registers a stellar 21 to 25%. Buffett also demands a clean balance sheet. HCA carries $47.5 billion in debt, which pushes the limits of this framework. However, an interest coverage ratio of 6.5 times proves that the debt load is highly manageable. Instead of Buffett's traditional owner earnings, we substitute free operating cash flow. S&P data shows HCA generated a massive $8.01 billion in free cash in 2025 alone. HCA passes as a dominant, high-return compounder within the Buffett framework. To ensure a strict margin of safety against the heavy debt load, the baseline buy target is set at $450 per share. Peter Lynch's growth at a reasonable price methodology categorizes HCA as a classic stalwart. It is a massive, predictable operation that uses share buybacks to steadily boost earnings per share. This math build calculates Lynch's favored metric, the PEG ratio. We take HCA's forward PE of 15.6 and divide it by their normalized EPS compound annual growth rate of 12%. That gives us a PEG ratio of 1.3. Lynch typically views high institutional ownership as a negative, preferring under-the-radar stocks. But the board's massive $10 billion buyback acts as a structural downside protector, absorbing excess institutional selling. A 1.3 PEG means HCA is fairly valued right now.
Under the Lynch framework, this is a textbook hold for current owners, and a buy strictly on macro-driven market dips. Benjamin Graham's defensive framework screens for massive size, earnings stability, and dividend growth. HCA easily clears all 3 hurdles, but the valuation breaks down at the next step. This graphic shows Graham's strict intrinsic value formula, the square root of 22.5 multiplied by earnings per share, multiplied by book value per share. When we input HCA's data, the math literally breaks. Taking the square root of a negative book value is impossible. This is the negative equity illusion. When a highly efficient company uses its free cash flow to continuously retire shares, it shrinks its equity on paper. This triggers false alarms on traditional asset screeners, even while actual earnings per share skyrocket. Graham's model was built for asset liquidations and physical manufacturing, not modern capital structures. For a hyper-efficient compounder like HCA, this framework is entirely obsolete. We pivot to the modern institutional standard, the discounted cash flow model. This treats the company purely as an engine for generating future cash. This bar chart maps the specific free operating cash flow projections from S&P. It starts at $7.01 billion in 2026 and scales aggressively up to $10.38 billion by 2029. To discount that cash back to the present day, we apply an 8% weighted average cost of capital and a 2.5% terminal growth rate, spread across 225 million shares. The final output values HCA at $842.97 per share. Even running a sensitivity matrix for worst-case scenarios, the mathematical fair value floor sits at $650. When judged strictly on its intrinsic ability to generate cash, HCA's long-term upside utterly dwarfs the short-term panic over the Affordable Care Act. We can run a reality check using standard relative valuation metrics. Applying a conservative 10 times multiple to 2026 EV to EBITDA estimates yields a fair value of $473. Looking at historical price to earnings, a reversion to its 5-year average multiple of 18 times yields a $545 price target. Even the most conservative back-of-the-napkin relative models suggest the current stock price is a mathematical floor, not a ceiling. This executive summary timeline consolidates all 5 frameworks into a single valuation matrix. We have Graham yielding not applicable, EV to EBITDA at 473, historical PE at 545, and the DCF model pointing to 842. The current trading price of $471.80 hugs the absolute lowest bear case valuations on the spectrum. This severe leftward skew represents a massive margin of safety for any investor willing to look past a 12-month window. The bear case risks are real. The company faces a $1.4 billion regulatory headwind, persistent labor inflation, and a heavy $47 billion debt load that requires execution from management. The bull case counters with phenomenal cash generation, structural Sunbelt market growth, and a $10 billion buyback retiring 4% of the float. The data points to a clear buy recommendation. The market is mispricing a one-time regulatory absorption event as a permanent impairment. Value investors should wait for the $450 floor. GARP investors should hold and buy the dips. Meanwhile, institutional cash flow buyers can accumulate heavily at current levels. HCA proves that evaluating modern capital structures requires moving past asset-based formulas from the mid-century toward a model that values the speed and efficiency of cash flow.